Hey guys, what's up? Okay, so good day. Welcome again to Redan Institute. So last time we talked about highs and lows. We talked about highs and lows. Now this is irrespective of your time frames. It works both on higher time frame, lower time frame, whatever it is. You understand that? So just highs and lows. So today we want to check another very important reference point. My favorite actually. It's my favorite. Fair value gaps. Yeah, fair value gaps. It is very very important. Let us check. Let's have a check from. Okay, let's just go to our weekly time frame. Or let's go to. Okay, let's go to our weekly time frame. So we have fair value gaps. So last time I talked about highs and lows. This is a high. This is a old high. This is under high here, right? Am I am I am I speaking French? Yeah. This is an high. It's an high. I told you there's always liquidity above in our highs, above our highs and our lows. You can see how the market came to take out this guy, then began to fall. Now there's something called fair value gap. Watch closely. Let me increase this. Now, fair value gaps are also called, or you can call them imbalance. You can call them volume imbalances. Fair value gap, volume imbalances. So these are places whereby price did not fill it up efficiently. So markets or yeah, the market makers then tend to return to those points, to those gaps, to have either a brief taste of it or to fill it up totally. Now, what do I mean? You see this place, this eye, this eye, and this low, this distance, this is a fair value gap. We only had a buyer in all of these places, no sales. So this gap, markets feel this between this week and this place, that's fair value gap. Don't worry, just follow me, you will get it. Follow me, follow me. Do you see that? Let me show you another place. You might need to increase your distance so you can be able to pick it where. Fair value gap are very essential. To me, they're one of the most important. Remember, this distance this week, right? This week, this distance here, this is your fair value gap. This is your fair value gap. Let's look at. Let's keep on checking. Let's keep on checking. From here to here, this one, this week here, this red candle this week. As you can see, after market went up a little bit, came back, test it here, and move. Can you see another fair value gap here? Fair value gaps. Fair value gaps. They are many like that. They are all over the market. All over the market. All over. You need to train your eyes to see them. And this gap is what we call imbalance. Price will always return to fill those places up. See this now. Come on now. You see this space? It ain't supposed to be. That's why you call it imbalance. It is price inefficiency. Now on your monthly time, on an higher time frame, sorry, on an higher time frame, it can close up totally because it is on an higher time frame. But when you come lower, you now see the picture clearly. So this is what? This is an imbalance from year to year. This is an imbalance. So this right here, can you see how markets came down, went up, came down? Took out this high. This is what? A brick market structure, right? Came down into a reference point. I will tell you what this is. Went up again. So before it started going up, see what market did. It came back into this imbalance, started going up. And if we check later in the future, can you see? Guys, can you see this thing? Can you see this thing? So we should do a proper analysis. Can you see this thing? Gets fill up, came back, tested this imbalance again. This same imbalance, this gap. Tested it, went up, break this structure, this high. It's the same thing. Markets repeat the same thing. Price repeats the same thing. All over and over and again. All over and over again. You see? That is from 2017. Or, yeah, this is March. This is May 2017. And so what market did. Market came back from that time. Imagine. So, let's even check what happened up here. See how much the market bought. This market is buying. See, it kept on buying and buying and buying. Bought, retraced, buy, came down to the reference point. So it came up again, went up a little bit. Remember, I said our eyes are what? They are reference points. You must pay attention to it. Your eyes are what? They are reference points. So see how markets went back up, took out all this liquidity here, these eyes, took them out, then came back to what? To fill up this gap fully. Came back to fill up this gap fully. Fill it up, then began to move up. Can you see that? So market came back to fill it up effectively, then moved up again. So market don't just go anyhow. It's going from somewhere into somewhere. You get, market is going from somewhere into somewhere. So these are reference points. I said I call this a what? An imbalance. Let me help you to label it for study purpose. You might need to watch this video all over and over again for you to grasp what I'm talking about. And that's the price you pay for mastery, bro. See that? Fill up this imbalance. Move up. It's as simple as that. This is the what? Fair value gap. FVG. Is a what? It's a fair value gap. I love to note them with dotted lines. It's just something personal. You don't have to do the same. Understanding what we're talking about is the major thing. So I just love to make it dotted so that, for clarity's sake. But anyway, that's it. That's it. That's it. So this is what happened here. So what happened here? Market broke this structure. That is, it took this I. So it didn't break the structure. It was a continuation. It took out this I. came down, went up a little bit. What do you see here? This is what a fair value gap, right? Market. Never can tell what the market wanted to do. Market. As long as you see it's market. Can you see how the market came back into this fair value gap? Went up a little bit. This is a weekly time frame, so you know this movement is not just a joke. It's not a joke at all. Where's my majority to? It's not a joke at all. Come on, this is 230, almost 250 pips. Look at this movement. 269 pips from this low to this high. 259 pips. It's not a joke, man. So market came to this fair value gap, went up into a reference point that we'll talk about next time. Came down. Went up again, took out liquidity. Yeah. High. Remember, our highs, they're attractive. What do you see here? This is a fair value gap. Now, let me just mark as many as possible as I'm seeing them. Just mark them. So you do the same for me, but you do it on 4 hours. You do the same for me, but you will do it on 4 hours. That's your assignment. Mark as many fair value gap as possible, but you mark them on what? 4 hours. Daily and 4 hours. Can you see this is a fair value gap? Market will come back here. One time or the other. Can you see this again? Let me increase this. I can see it even without the screen being increased. Yeah, because that's consistent practice anyway. It wasn't like that when I started. Can you see this? This is a fair value gap. This is another fair value gap here. But most time when markets have an huge move like this, it tends to return to the closest fair value gap. Now there's a way we take this entry. We don't just set our price here. This is a weekly time frame, so your stop loss will be huge. Imagine you placing your sell here and your stop loss is here. Come on, that's too much. So we'll be looking at other trade examples. How you could have taken advantage of this. But first and foremost is understanding the market. Once you understand how the market works, placing trade will not be a problem. It won't be a problem at all. It won't. So this is it. This is a fair value gap. This is another fair value gap up here. Market used to retrace where. Remember I said retracement is when price returns into a particular reference point for continuation sake. The market has been selling. Market has been selling. It has been selling. It went up here. Boom, boom, come down. And what? It broke structure here. Remember, this is a break market structure on an higher time frame. That's a very strong one. What do you call this? This is an old low. That's an old low. Market came down. Big structure. Went up, retraced to a reference point here. Came down again. All this took time to form. It took time, months, days. So another fair value gap here. See, once you understand the mystery behind fair value gap, or more, you're in money. Can you see? So let's assume you miss all of this trade, you miss all of this, and market started consolidating. And it's always advisable to stay away from the market when it is consolidating, because market is making many indecision. Imagine you wanted to you buy here, market went, played with your emotion, came down, probably you're breaking even, took you out, you wanted to buy again. You're just playing with your emotions, up, down. Oh, market wants to sell, you sold. Market should come here and take out this old low. It didn't come out to it didn't come to take this old low. Instead, market came down, went up again. I gave an some kind of hypertension again, came down again, went up to take it out again. All of those stress. This is a consolidation market. You don't need to be there. Just wait for something clear. I know this is also what a fair value gap. This is a fair value gap. Markets came here, fill up this place, came down a little bit, took out this low, took out this low. Then before we start moving up, let me delete that so that it will make the charts too clumsy. So you see how the markets came down. Fair value gap, fill it up a little bit, came down, went up. That know how to fill it up to the brim, fill it up totally, went up to this point. They started coming down again. Can you see the market came down, took out this low, and market still went up again into what? Still that fair value gap, reference point. So once you see the market moving this way, you just have to be just calm down. Take your profit, rest. Take your profit, rest. Oh, you caught this move, you sold down to this place. Your take profits here, your take profits here. Once you are done, wait. Okay, what's the market doing? Took out this low, gave you a big structure on a very smaller time frame, smaller than 1 week, probably 1 hour or H4. Went up. Remember how I said breaking structure is? Please never forget. Never forget. Market is buying, it is buying, it is buying, buying. All of a sudden, it broke a low, went back into a reference where probably fair value gap or another reference one that I will talk about, then continue to sell. This is what this is. This place here is a brick market structure. So let's say the market is selling, 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 selling. Immediately it failed to take out this low, instead it stopped here, went up to take out this high. But just expect market to come down somewhere into a reference point, either a fair value gap, majorly a fair value gap, or any other reference point. But always look out for a fair value gap. It's very strong. The market will just keep on buying. So that's what market does. Can you see? Sorry, I picked something wrongly. Okay. So same thing I said before. Is also a what? An imbalance. This is a what? An imbalance. So market went up to a fair value gap, came down, tested it a little bit, came down again to fill it up. Now, there's something else I want us to know. Remember, this is a what? Fair value gap, FVG. Fair value gap, FVG. Now, when you have an huge, so it is an imbalance. Sorry, imbalance and fair value gap. They are almost the same thing, but this is an imbalance. There's no candle in between them. So that gap is an imbalance. This here is a fair value gap. So they are both family. They are siblings. Sorry. So the fair value gap. This week is an imbalance. It's not filled up. Now, pay attention to this. What I want to say right now. When you have an huge imbalance like this, 50% of it is called encroachment, consequent encroachment. This is the best time for me to teach you this. So at times, markets tend to want to fill up half of it. That's 50%. This place, this point here. That is what? That is 50%. It means consequent encroachment. That's what Fibonacci that I pick. So this is what market did here. This is what market did here. Sometimes market will not go leave that zone totally until it fills at least 50% of the fair value gap. Oh no. 52. Can delete this. Let me pick it up a little bit. Yeah, perfect. So this right here is called your CE. Consequence consequent encroachment. That is 50% of your fair value gap. That is it. See how the market came to fill up this fair value gap, came up, came down, fill it up again, came down, and touch. So how the market does, might not necessarily fill it up totally. Unlike here, it's filled it up to the brim. It filled up the entire, it came to balance up this gap. This gap should not be there. Look at this, there's no fair value gap here, right? No fair value gap. There's fair value gap here, fair value gap here. No fair value gap here. So most time when you see gaps like that, markets most times will always want to come back to fill it up. Let's see. I think we have something here too. Let me delete this. I made this of it already. That was a volume imbalance. Volume imbalance. So of you be wondering that how is this guy seeing all these tiny things? Yeah. Stay with your chart, you will see it. No matter the grammar I'm saying here, if you don't spend time checking these things, you won't get it. it will look difficult until you begin to spend time with the chart, at least 2 to 3 hours daily. Can you see how the markets came here? Markets, created price, created a fair value gap here. This time between this week and this week, market came up to fill this place and start moving. Can you see? Can you see that, guys? Nothing happened at random. Nothing. Nothing happens at random. And this thing happens when this low was taken out. So every time market moves into a fair value gap, it's always probably after a reference point that we taken out. You see, this is a reference point, an external liquidity, internal liquidity. So markets moves from an external liquidity, external liquidity to internal liquidity. External to internal liquidity, and vice versa. So I will explain later what this word means. Just hold it somewhere. I will explain it in our next video. So external to internal. So you took out this old low to go back into what a fair value gap. Alright? Came down again, took it out, went back to touch the consequent encroachment, that is 50% of the fair value gap. Came down, take it out. Okay, I think I hear somebody say, please show us. You've seen it before, guys. What I'm talking about. Came to fill up this place a little bit, then came to touch towards the 50% of that fair value gap. The market will continue moving downwards. This is a retracement into what? A level. For continuation sake, it continue moving downwards. Guys, it is all about the market. So go do your homework. Again, pick 5 different assets, do the same thing, then screenshot it, then screenshot what you have. It's a fair value gap, this gap here, then this gap. I'll just screenshot this here. Pop. Can you see? Fair value gap. Fill it up, came down. It happens every time, guys. See, market came down again. It didn't just continue going down, even though the aim was to go way down. It didn't just keep on going way down. So it came back to what? To fill up this fair value gap and continue moving downwards. See the same thing here. There's a fair value gap here too. Mark everything. You say, oh, it's too much. You don't know which one we hold, so mark it. So we don't just enter the market anyhow, though. There's a pattern. We will learn that in the course. So guys, have a good time. I don't want to make this long. See you again. See another fair value gap here. Market really tough, came down. Then finally you have what? A breaking structure. Finally. So even after this breaking structure, oh, this is sweet. Even after this breaking structure, you can pick this candle. You can also pick this candle too. So what happened? This thing happens like fire. So market went up, came down into fair value gap. Oh my god! Nothing happens at random. Nothing. Nothing. So I will leave this for the sake of the next class. I will want to explain some few things. Can you say market went up, came down to fill up this fair value gap, went up again. So I want to go to as many time frames as possible. Can check your daily, can check your 1 hour. It's the same thing, guys. Don't say this guy. It's the same thing. It's the same thing. It's the same thing. It is the same thing. Markets repeat itself. It's the same. Whatever is happening on the higher time frame, just interpret it down to the lower time frame. It's the same thing, guys. It's the same thing. It is the same thing. It's the same thing. I've seen one fair value gap. It's the same thing everywhere. Everywhere, guys. It's the same thing. See, it's the same thing. It's the same thing, guys. See, it's a fair value gap. This gap here. This week and this week. This week, you see, it's the same thing, guys. I've seen another one here too. This week and this week. Can you see this too? It's a fair value gap. Market came down, fill it up, and moved. It's the same thing everywhere. You see any that fair value gap here? There's a fair value gap here. This place and this place. Small value fair value gap came up here, move. So you know why some hold and some does not hold. I'll explain all of that for us. Same thing, fair value gap. Fair value gap. Mark it, even though if it does not work the way you wanted it to work, you just mark it and submit it. It's a fair value gap here. It's a fair value gap here. Mark it. A fair value gap. Imagine you didn't mark this. This is a previous. This is on Monday. This is on Tuesday. So imagine you forgot to mark this. You wouldn't know. You wouldn't know why the market wants to sell at this place. You wouldn't know. Imagine you forgot to mark this. Mark it. Market got there. Rejected. Break market structure. Clean. Went up. Came down. Take liquidity. Came down. Break market structure. Enter here. It's simple, guys. It's simple. So let's just wrap up here. And we will go to the third reference point. Order blocks.